This presentation is merely a brief overview of the topics covered in the chapter and should not be considered a substitute for reading the chapter. This chapter covers some of the attractions and drawbacks of real estate investing and explores some options for making money in real estate. As we covered earlier in the semester, wealth is primarily built through ownership investments. Owning stock, small businesses, and real estate are the path to financial success for many wealthy people. Some people may believe that because real estate is down at a certain point in time, that it will remain down and should be avoided. Instead, we should view real estate in much the same way as we view stock investments. There will be peaks and there will be valleys, and valleys often represent good buying opportunities for those with the means to invest and hold on for another peak. Real estate is an attractive investment for a number of reasons. The fact that land is limited makes it valuable, and the more limited, the more valuable. Why is land in Manhattan so valuable? Because it's limited, and there are more people who want to own it than land to own. For many people, it is a desirable place to live and work. For many businesses, it is the place to be, so they must establish offices and/or retail outlets there. For many tourists, it is a fun place to visit. For all of these reasons and more, the limited land and the desire of so many people and businesses to be there create a situation of demand being greater than supply, and when that is the case, prices tend to rise. With a real estate investment, investors typically don't pay for the entire investment all at once. Instead, they usually put some money down and then borrow the rest, making monthly payments to pay off the loan. For example, an investor may buy a small apartment building worth $1 million by putting down only 20% and borrowing the rest. Still, the investor who has only put $200,000 toward the investment controls the entire investment. Being able to control an investment with mostly borrowed money is called leverage. If the value of the apartments increase at a rate that is higher than the rate of the loan, the investor will be a winner. Investors make money on real estate two ways. First, investors expect the value of the real estate to increase over time, so to appreciate in value. Buying land at $1 million and selling it a few years later at $1.5 million would mean that the investor saw the value of her land appreciate by $500,000 over time. Another way to make money with real estate is through generating income from rent. If an investor's annual costs and expenses on a rental property are $10,000 per year, and she brings in $12,500 per year in rental income, she made $2,500 in rental income, and she has the added benefit of being 1 year closer to paying off her loan and eventually owning the property outright. Money earned in different ways is taxed differently. For example, if you earn $50,000 this year by working for a company, your earnings will be taxed at the individual income tax rate. In this case, in 2011, that rate would be 25%. If you earned a $50,000 profit by selling stock held outside of a retirement account, that $50,000 would be taxed at 25% if you held the stock less than 1 year, and at 15% as a long-term capital gain if you held that stock for more than 1 year before selling. This is true regardless of whether you pocket the money or reinvest it in more stock. With real estate, it may be possible to avoid taxes if you sell a real estate investment and then roll the money over into a similar investment. Let's say you had a $50,000 profit from selling some real estate. If you roll that over into a similar real estate investment, you may be able to avoid all tax burdens from this transaction. However, if you didn't roll it over, you would probably be taxed at the 25% rate, plus you would also owe a tax burden for any depreciation that you took on the real estate investment over time. Complicated, right? Well, real estate taxes are complicated, and that's why it usually pays to seek out professional help from an attorney and/or tax advisor. Why? Because if you reinvest in a similar property through something called a 1031 exchange, also called a Starker exchange, and avoid taking possession of the proceeds of the sale through setting up an escrow account, you can avoid being taxed. Of course, tax laws change over time, so be sure to consult with a professional before making any decisions about selling property. You can't buy a stock and fix it up so that it is more desirable, but you can do that with real estate. Buying a home that is in need of some TLC and redecorating can be a good investment. A $25,000 investment in sprucing a home up and making it more attractive and appealing can yield a return on investment that is as much as 100% or more in some cases. Real estate is a tangible asset. We can see it, and so can others. Owning certain real estate provides a sense of ego gratification. I don't know about you, but when I think of real estate and ego, I think of Donald Trump. Mr. Trump has many investments, but he seems to take great pride in his real estate investments and loves throwing the Trump name on them. Not only does the Trump name on property likely raise the value and prestige, it gives Mr. Trump the ego boost he loves. Investing in real estate requires a long time horizon because real estate investments are illiquid. This lack of liquidity makes real estate a bad place to invest for those who do not have the patience to wait or who may need to access the cash from their investment quickly. Real estate is also a bad choice of investment for those who do not find it interesting. Similar returns can be had in the stock market, and someone who does well in the stock market and has no interest in real estate is probably better off sticking with stock market investing. When we think of real estate investing, we usually think of direct property investments where the investor buys, owns, and controls a particular property. However, there is another option, which is called real estate investment trusts, or REITs. REITs are entities that invest in different types of properties, such as apartments or commercial real estate, on behalf of investors. With a REIT, an investor need not worry about identifying properties, negotiating the purchase price, or managing the properties. Instead, a professional REIT manager handles all of that. So if you're interested in real estate investing, perhaps from a return or diversification perspective, but want to avoid most of the hassles of buying and managing real estate investments, a real estate investment trust just might be an investment worth checking out. That is the end of this presentation. I hope you enjoy reading the chapter.